Larry Walther. This is principlesofaccounting.com, Chapter 9. In this module, we are going to look at the available for sale security category of investments and how to account for those. Okay? First of all, available for sale securities are reported on the balance sheet at their fair value. The accounting is very similar to trading securities that we looked at in Chapter 6. There's an important difference, however, and that is that changes in value in these investments, rather than going to operating income each period, go to a unique category of income called unrealized gains or losses, other comprehensive income. So other comprehensive income is now a new term. It is a unique classification or category of comprehensive income. It's not part of operating income. It's a separate category or unique classification. Recognize that for trading securities, the gain or loss or changes in value went to operating income. Now we're going to this other comprehensive income to reflect the changes in value for available for sale securities. Recognize that most transactions and events make their way through the income statement. Therefore, the income statement is deemed to be all-inclusive. Historically, once upon a time many years ago, accountants viewed income as only relating to current operating concepts. Transactions and events that were not directly related to operations might have been charged or credited directly to stockholders' equity and bypassed the income statement entirely. Companies have a variety of reporting options related to other comprehensive income. It can be reported in a comprehensive income statement. This goes beyond just the operating income that's seen in what you might consider to be the normal income statement. Or other comprehensive income can be measured and reported in a separate schedule that reconciles the company's reported operating net income to the total comprehensive income of the business. Let's look at an example now. This will help clarify perhaps. A Webster company acquired an investment in Miriam Company. The intent was not for trading control or to exert significant influence. It's classified as available for sale. It was purchased for $50,000. We debit the investment account available for sale securities and credit cash on the date of acquisition. Financial statements were prepared at the end of the month. The value of the investments declined from its $10 purchase price to $9 a share. And here's how we're going to do this. We're going to debit unrealized gain or loss dash other comprehensive income. That's that other comprehensive income component charge that's going to be offset against our stockholders' equity, and we'll credit the investment account available for sale securities. The rationale here is that net income is not affected by these temporary fluctuations on investments that we're holding for more than just trading purposes, and so we're going to carve them out into other comprehensive income rather than flowing them through our normal operating income. During the next month, the stock jumps up $3 in value, so we have a $15,000 recovery in value. We're going to debit or increase the investment account $15,000, and we're going to credit this other comprehensive income unrealized gain or loss account. After the three journal entries, the investment account has been changed to be reflecting $60,000 in value. The initial $50,000 minus the $5,000 write-down plus the $15,000 write-up. That equals its market value at the balance sheet date. And the other comprehensive income has an adjusted total of $10,000 in credits, the $5,000 debit from month 1 and the $15,000 credit from month 2. Now, the treatment would be the same even if the available for sale securities consist of a portfolio of many investments. An alternative to directly adjusting the available for sale securities account might be to carry a valuation adjustment account like the allowance for uncollectible accounts or something like that that would offset or increase the investment category. In my journal entries, I just debited and credited the investment account directly. That separate valuation account can be added or subtracted to the available for sale securities at cost to bring them to fair value. It provides the same net results, but it gives additional information about what the relative differences are between cost and market value, and it's certainly useful for tracking tax basis information. The tax law does not adjust investments to fair value at each financial statement date, as do the financial accounting rules. If we had dividend income on this, debit cash and credit dividend income here. This is in addition to the recording of the gains and losses that flow into OCI. The dividend income is considered to be operating income in this case. It might be helpful to look at our example on a balance sheet. Here we had the available for sale securities at the end of March valued at $45,000. That was the $50,000 minus the $5,000 write-down. And our offsetting debit is shown as a reduction from stockholders' equity as accumulated other comprehensive income or loss. If we go to the next month, we've got our available for sale securities at $60,000, and our other comprehensive income account accumulated is now carrying a $10,000 net credit balance, which increases stockholders' equity. So we're reflecting the change in value, but we're not impacting the operating income through the normal income statement, it's only considered to be an other comprehensive income account that's generally regarded as a direct adjustment to the equity accounts.